Let's just be real for a second. For most of us, the stock market can feel like this high-stakes game that's, well, kind of rigged for the experts, right? We all want to build wealth, but at the same time, we're absolutely terrified of making that one huge mistake. So how in the world do you navigate all of that without needing a finance degree or taking just insane risks? And that really is the big question, isn't it? This is exactly what we're going to tackle here. It is the #1 concern for pretty much anyone who wants to invest for the long haul, but who also really, really wants to protect their hard-earned money over just chasing some lottery ticket win. Okay, so let's get into it. The answer, it turns out, comes from a guy named Benjamin Graham. Now, if that name sounds familiar, it's because he was the legendary investor who actually mentored Warren Buffett. And he created this simple but incredibly powerful framework, and he designed it specifically for what he called the defensive investor, which is basically his term for regular people like you and me, people who want safety and, freedom from constant stress. So what was his big idea? Well, he basically distilled his entire philosophy down into 4 really straightforward rules. Seriously, think of it like a pre-flight checklist for your money. It's designed to stop you from doing anything reckless and just keep you totally grounded. Here they are, just at a glance. You've got diversification, company quality, dividend history, and a super strict price limit. Each one of these is like its own layer of protection, and when you put them all together, they create this really powerful system for just minimizing mistakes. So let's break them down. So here's how these rules all build on each other. First up, diversification. That just means holding somewhere between 10 and 30 stocks. It protects you in case one company just totally goes belly up. Second, you stick to large, financially stable companies, the kind that aren't going to collapse in a bad economy. Third, you demand a long history of paying out dividends. We're talking 20+ years. Why? Because it's proof of real, consistent profitability. And finally, and this is probably the most important rule, never, ever overpay. Graham set a strict limit here. He basically said you shouldn't pay more than about 20 to 25 times a company's recent average earnings. And that last rule? Oh man, it is so crucial because it helps you avoid the single biggest danger for most investors, the siren's call of the hot growth stock. You know the ones I'm talking about. They're the companies everyone is buzzing about, with these exciting stories that way too often are just masking extreme risk. Now check this out, this visual really shows you the problem. Graham pointed to examples like IBM back in the early 60s. I mean, their earnings were growing, which was great, but its stock price shot up 5 times faster. It just completely detached from the reality of the business. So when the mood changed, even for a fantastic company, the stock price could just collapse. It really shows the danger of paying for hype instead of actual value. And listen, this is not ancient history. As the commentator Jason Zweig points out here, this pattern is absolutely timeless. The same thing happened 30 years later with giants like Microsoft and Cisco during the dot-com bust. A great company is not a great investment if you pay a ridiculous price for it. It's as simple as that. Okay, so if chasing hot stocks is out, what's in? Well, Graham's solution is this brilliant, almost mechanical system that removes your biggest liability from the entire process, your own emotions, right? Fear and greed, they cause us to buy high and sell low, and this method just short-circuits that whole impulse. It's called dollar cost averaging, and the concept behind it is incredibly simple. You just invest a fixed amount of money, let's say it's $200 every single month, no matter what the market is doing. You don't ask, hey, is now a good time? Nope, the decision is already made for you. It's completely automatic. And here's where the magic happens. It's awesome. When prices are high, your fixed $200 buys you fewer shares. But when prices fall, when everyone else is panicking and selling, your same $200 automatically buys you more shares. It literally forces you to buy low, systematically bringing down your average cost over time, all without any guesswork. So how well does this actually work? Well, in a really famous study by Lucille Tomlinson, they analyzed 23 different 10-year periods, and this included the Great Depression, and every single one of them ended with a profit, 100%. The average profit was over 21%. I mean, that is the power of discipline over emotion. All of this leads to what might be Graham's most profound insight of all. It's a complete reframing of what risk actually means when you're investing, and it challenges the very definition that Wall Street uses every single day. So here's the difference. Wall Street defines risk as volatility, the ups and downs of the market. But Graham said, nope, That's not the real risk, that's just noise. The real risk, the one that causes you to permanently lose your money, is paying too much for something in the first place. This visual explains it perfectly. The main danger isn't a market crash, it's buying a company for more than it's actually fundamentally worth. Graham's whole philosophy is built on this idea of buying good businesses at a significant discount to what they're worth. He called this the margin of safety, and it is your ultimate protection against losing money. So, as we wrap up, this is really the question Graham leaves us with. Are you trying to guess the future? Are you chasing hot trends and predicting what the market's going to do next? Or are you following a disciplined, time-tested process that's designed for safety and for steady, long-term growth? Because at the end of the day, your answer to that question will define your success as an investor.